Hello and welcome to today's video where we'll be discussing getting funding or financing, and this video is part of a collection of videos in the entrepreneurship and e-commerce course. I guess so far we're on the journey where we've looked at our idea and how we generate our idea, and then we've done the feasibility testing on that idea, which has sort of led us to developing a business plan and that customer validation through marketing. We've looked at the industry and industry analysis and the value chain and things like that there. And really where we're at now is, okay, this is starting to become more real. Well, how do we get the funding or financing for this idea? And if we go back to the feasibility analysis, we talked about, needing total startup cash was the cash or the money that we needed to get us to that first sale. So, what we really have to do is figure out how much money do we need to get us to that first sale, and I suppose a bit more. So we'll look just at some ways of getting funding and financing today. What are the standard methods of getting funding and financing, particularly at the very, very early startup stage, and then as we move on, maybe more to the business developing and getting further rounds of funding and things like that. So yeah, so that why get finance? These are just the three things that we're going to look at today, and we'll go through them in a little bit. But just the first thing, the importance of getting financing or funding. Well, few people deal with this process of raising money until they need the money. As a result, many entrepreneurs go about the task of raising capital haphazardly because they lack experience in this area. And I guess that's what these slides are for, is just to sort of, give us a good understanding of finance and funding, and that we're working on how we're going to get this financing and funding very early on in the stage, and to get a good understanding of it early on is important, because it can save you a lot of money and difficulties in the future as well. So let's look at some of these reasons that we need financing or funding. So why most new ventures or startups need financing or funding? Well, the obvious is cash flow challenges. We have to buy inventory, whether that's laptops and software, or whether it's we're starting a new restaurant, even in the traditional sense. You have to buy your equipment, your deep pat fryers, your hot plates, your pans, your equipment. Obviously, employees must be trained and paid. So, if we're mobile app creators, are we going to employ software engineers? And they're going to be needed at that startup stage. They're going to be needed to help us develop the product while we haven't made any sales yet or downloads. So advertising and that marketing that we need, even for launching our new business and our new product, you're going to need money to do that. Whether that's advertising through online methods or traditional methods, you will need some cash. So cash flow challenge is the first reason that we look at. Capital investment, of course, is things like buying real estate facilities, equipment, and that's the obvious stuff. Lengthy product development cycle is just another consideration. And again, we mentioned that we might need to get a software engineer to work on developing a mobile application. We're not going to have a mobile app ready overnight unless this is something that you have been working away at on your own. You're going to need to develop the app and get it validated by customers, get them using it, see what they think about it, making changes. Of course, maybe one of the greatest examples of lengthy product development cycles is in the pharmaceutical industry, where drugs tend to take a long period of time to get regulated and approved, because there's a lot of clinical trials and time and effort that goes into them. So you can be developing a new drug or new biotech technology, and the product development cycle can be very long. So obviously we need funding while we are developing that product. So just some alternative ways for raising money for a new company or new business, and we're going to look at each of these: personal funds, equity, debt financing, and throughout all of these, some creative sources as well. So the first um, financing we're looking at is sources of personal financing, and I guess this is often the one that you use at the very start. And I remember myself, I guess, with my own first business, it was very much personal financing that I used to help me get the business off the ground. Before I went looking for grants and debt financing or anything like that there. And of course, my first company was a digital marketing company. So, it was personal finances. And a lot of these stuff that I'm going to go through was a lot of things that I actually used myself. So the vast majority of founders contribute personal funds along with sweat equity to their venture, and sweat equity just refers to effort. So a lot of effort or the value of their effort. So sweat equity represents the value of the time and effort that a founder puts into a new venture. I didn't realize I'd explained that. Friends and family are second sources of funds for many new ventures, and they can be. And again, we covered in the legality video, just to be very conscious of getting everything in writing with your friends and family, if that is the source, and if there's, some agreement in place there. Bootstrapping, which we're going to look at now in more detail, which is a third source of startup or seed money for a new venture. And it's finding ways to avoid the need for external financing through creativity, ingenuity, thriftiness, cost cutting, or any means necessary. And many entrepreneurs bootstrap out of necessity, and I certainly did as well. When you're starting that business and you've left a job, okay, you have some savings, or maybe in some instances you don't have any savings. I had savings when I started, but I was very conscious of the fact that it could be a year before I had any sort of real good profit or income coming in. So at the very start, I was very frugal, thrifty, and came up with many different ways of bootstrapping. Some here that we use, and I'll tell you some of mine towards the end. Buying used instead of new equipment. That's true. The first ever MacBook Pro I bought was second hand, and I still have it today, and it is held together by insulating tape because I dropped it down the stairs, but it still works, and I still use it and go back to it sometimes, but mainly for downloading. But yeah, used instead of new equipment is a good way of bootstrapping, and I think I've kept that laptop probably for sentimental reasons. But anyway. Coordinating purchases with other businesses is something that you can do if you're, in a company that it suits that, someone else might get the use out of it as well, and you can come to some agreement. Leasing equipment instead of buying, which is obviously you're renting the equipment out instead of buying. So you if you were, for example, some of our students here are doing a lot of 3D printing. You may not, to get an industry spec 3D printer might be 10,000 or something like that there, and you may not be able to afford it, but you could be able to lease it at the start with an option to buy, and that leasing just keeps your costs down at the start. Obtaining payments in advance from customers, again, my first business, this is something that I did, and but not simple, because at the end of the day, there's a little bit of loyalty that you expect from a new customer, that why should they trust you? And I think it was only because I knew a couple of my first clients that I was able to sort of get the upfront money. Minimal personal expenses, absolutely. I ate beans on toast a lot with noodles, my diet for the first year or two. And also I would say that I borrowed Wi-Fi from local hotels a lot, avoiding unnecessary expenses. So don't get your Wi-Fi from a credible source. borrowed from hotels and cafes. Buying items cheaply, prudently, yes, of course. Sharing office space, and that's one I done as well. With my clients, I shared an office space in exchange for some in-house marketing, or sorry, some freelance marketing that we offered them, and hiring interns. And that again was really how my business started off. You know, I took on a couple of, or I took on an intern, and that allowed me to sort of go out and get a couple of new customers. And then, you know, when I had sort of the time to get new customers, then I could actually appoint that intern to those customers, and we worked together. And then, you know, after I was comfortable, that the intern was comfortable with those customers, I could look at getting another intern, and then we kind of built it. Our first 10 staff were probably interns as well. Okay. And I should say that I hired them all after, straight away. So it wasn't a case of just using and abusing, which I have seen happen. We were quite conscious to keep our interns in, keep them on. So anyway, sorry, preparing to raise debt or equity financing. So, you know, preparing to raise debt, basically to get money through debt or equity financing, which is sorry, I should explain these. So preparing to raise debt is, you know, where you go to a bank and look to raise money through debt or a lender. And equity financing, of course, is swapping some of the value of your company for money, and how you do that. And we look at that. So the first thing we do is determine how much money we actually need, and that is where we go back to our sort of total startup cash needed. What is, you know, you have to be able to work out, okay, well, how much money do I need really to get to that first point of sale? And that's always a good place to start. You know, and then, as we'll see in the next video, we sort of look at financial management, where we make forecasts and things like that there, predictions of our first and second and third year of business. But for now, you know, we have to look at, you know, how much money do we need to get us to that startup point. Step 2, once we know how much we need, determine the type of financing or funding that is most appropriate. So, you know, okay, if I realize that I need 2,000 BD, do I go, okay, or let's see, I could get a loan off my family or friends. If it's 10,000 BD, you know, I might go, right, I need to get you know, a bank loan here, and if it's 100,000 BD, maybe I need to get an investor in and trade off some of the ownership of my company. So then you develop a strategy for engaging either that investor or banking. So that's just the steps in it. Two most common alternatives in raising debt or financing: equity funding, which means exchanging partial ownership in a firm, usually in the form of stock, for funding. And what I would say there is that's not uncommon, that, you know, investors or venture capitalists or whatever it is, you know, raising funds for the company. Well, there's a trade-off in the stock of the company. So, for example, you know, if I was a new startup and you know, it's a good idea, then perhaps I might approach an investor and offer that investor, you know, maybe 10 or 20% for 10 or 20,000 BD or 100,000 BD, or, you know, that's what we decide when we're doing it. But equity funding basically means that you're trading off partial ownership. And I'm reading Bad Blood at the moment, which is a book about Elizabeth Holmes, an entrepreneur in Silicon Valley who went rogue, I guess. And I suppose what kept her going was she had a lot of contacts, but what she did to fight a lot of the legal, or to challenge and protect herself legally, was she swapped equity in the company in exchange for the best solicitor in America. So the best solicitor in America was representing her because he was getting an equity share of the company. Debt financing is getting a loan. Simple. And of course, getting a loan is getting a loan from a bank, or indeed maybe friends or family. Usually, not always, but usually debt financing loans, you will pay interest on the loan. And how that works, for example, is I might get a 10,000 BD loan. I have to pay it back over 5 years. I may have to pay a 1 or 2 or 10% interest on that loan, which means if I'm paying 10% interest on a 10,000 BD loan, it means that I have to pay back 11,000 BD. And of course, if it's over 5 years, it might be annually compounded interest. So I pay back 2,200, whatever it is, the first year, and obviously I have to pay back more than I get. That is usually what happens in debt financing. This little chart here is just I'll name the book at the end of the video that I've got it from. Sorry, but it's a good graph that explains when the type of venture, where it is at, where the venture is at in its life cycle, and what type of funding, the appropriate kind of funding. So the business has high risk with a uncertain return, weak cash flow, high leverage, low to moderate growth, unproven management. Well, this is the kind of funding that you're really realistically looking at. The business has low risk with a more predictable return. So these sort of things. Now you're looking at debt financing, maybe through a bank. And of course, this is where we might look for equity. Unique business idea, high growth, niche market, proven management. Okay, so that was just some looking at debt or equity financing. So, when we do the equity financing, we talk about this thing called an elevator speech. And an elevator speech is a speech that you will, I guess, give to the prospective investor or future investor. And we often see this in the TV show Dragon's Den, where at the start they have a couple of minutes to make their pitch of their idea, try and sell this great idea that they've got. So what you're really doing is making a very brief speech, which we say is carefully constructed. So you've sort of constructed this speech in your mind before you've ever had to make it. And this speech outlines the merits or the good things about this business opportunity that you have for an investor. So you're going to invest, you're looking for money, but you're saying to the investor, look, this is a terrific idea, but in return, you're also going to get X, Y, and Z out of it. And there are many occasions when a carefully constructed elevator speech might come in handy. So you'd be surprised, conferences and different things like that there. They say most elevator speeches are 45 seconds to 2 minutes long, and this kind of comes from where elevator speech came from, which was, if you walk into the old traditional high-rise buildings in America and you happen to get into an elevator with an investor or the boss or something, you only ever really had 45 seconds to 2 minutes by the time it took the elevator to get from the bottom to the top to pitch your idea. So that's why it is called an elevator speech. And of course, this is often the way, investors aren't going to give you away their time freely. As we know, most entrepreneurs are often very busy and workaholics, and they might listen to you for a minute or two, but if you don't get them in that first minute or two, you've missed your opportunity. Here's a little sort of, you can have a look at it yourself, but it's what should be in an elevator speech. Describe the problem that needs to be solve, describe how your product meets that and solves the problem, describe your own qualifications, describe your market, total 60 seconds. In and out, not simple. But that's just an idea of what an elevator speech is, and I guess, before someone ever gets your business plan or your concept statement, the elevator speech is usually the first thing that will happen before they get either of those. And again, important to know that as I say, even lenders, you go into a bank, you're going to be that first meeting and the importance of first impressions, and you explain to the bank manager that you're able to sell it in that 1 to 2 minutes very quickly is very important. Just some other sources of equity funding. So, we've sort of said debt financing, really. The main way is banking, lending, or of course, any other lenders that you can think of. Sources of equity funding. We have venture capital, business angels, and initial public offerings. And I might even add in there crowdfunding at the moment as well. But we'll look at these three, maybe discuss crowdfunding just as a caveat at the end. But so venture capital, I mean, we may have heard these terms before. Venture capital companies, they tend to be big companies with a lot of wealth. But what have we written here? Is money that is invested by so venture capital is money that is invested by venture capital companies in startups and small businesses with exceptional growth potential. So it is money that's invested in small businesses with exceptional growth potential. And that's just to be aware that venture capitals are not going to invest in low growth rate companies. So if your idea is starting up just a normal restaurant, then your venture capital funding is not for you. Venture capital firms or companies are limited partnerships of money managers who raise money and funds to invest in startups and grow. So it tends to be a group of money managers that get together to raise money, and then what they do is they invest in startup companies that have good growth potential or exceptional growth potential. And what they're really looking for is, we say they're looking for the home run. They're looking, these are money managers that get together, people with money that want to invest money, and they want to invest their money wisely so that they get a good return on their money. So, they do their research well. The funds or pool of money are raised from wealthy individuals, pension plans, university endowments, foreign investors, and similar sources. The investors who invest in venture capital funds are called limited partners, and they are limited to the amount that they invest usually. And then the venture capitalists are called the general partners. So it's a group of I guess, investors and money managers and money makers put together to decide on the best companies to invest in. The best startup companies. Venture capital firms or companies fund very few entrepreneurial firms in compared to business angels, and that's true. They tend to only invest in the ones that are highly likely to be to be successful. And while that is hard enough to I guess predict, there are things that you can help to predict it. You can sort of, could you predict that Uber was going to be so successful, or Google was going to be successful back then? Well, that's the venture capital's job. Many entrepreneurs get discouraged when they are repeatedly rejected from venture capital funding, even though they may have an excellent business plan, and that's true. Venture capitalists, as we said, are looking for the home run. So they do reject the majority of proposals they consider. And there were some statistics from America in 2015, quite a bit back now actually. It might have even been 13 venture capitalist funds, between 3,000 to 4,000 companies per year, compared to 62,000 per year for business angels. And we're going to look at them in a second. Venture capital funding is, they say, an important part is going through due diligence. So as I said, you have these money managers and money investors. Well, they tend to scrutinize the business in a diligent way that shows that they won't get caught out in case the company goes rogue. And of course, Bad Blood, the Theranos was the name of the company, I guess, that got huge funding from venture capital firms, but they were basically lying to their to the investors. And how they got away with it, I guess, was that they had a very strong network of directors, sort of trusted and loyal, highly esteemed directors that trusted the CEO of the company. Venture capitalists invest money in startups in stages, meaning that not all the money that is invested is dispersed at the same time, and all that means is, you might get 100 million in funding, but you're not going to get that 100 million up front. You're going to get 1 million to get you to this phase, and then the next phase they're going to release another 10 million, etc. Things like that there. So again, it's just that the way that they do it to protect themselves, but you should have an idea of a growth plan as well. Some venture capitalists also specialize in certain stages of funding. So round one, round two, round three, they are different stages of funding in raising money through venture capitals. Business angels, which we've heard now. Business angels, well, not so much angels, really getting something in return, but they are individuals who invest their personal capital directly in startups. And what that means is, you might be a fresh graduate out of college and you don't have much money, but you think you have a very good idea, and you've done a good business plan, and you think there's a gap in the market and a great opportunity for this idea, but you just can't get the funding. Banks, as we'll see, don't tend to give out money too easily to high risk opportunities. So how are you going to really get the money to develop this great idea? Well, a business angel is someone who may come along and go, okay, you know what, we'll spend 5 or 10,000 BD here to help you get off the ground. However, I want 20, 30, 40% of your company. And you have to sort of go, okay, well, do I give away 40% of my company for 10,000? This is the dilemma that you can be in with business angels. And again, TV show Dragon's Den, you should look up, is quite good, where potential investors look for business angels to come in and help support them financially to get them to the next stage of the business. So not quite angels, but I guess if they are giving you money, and they often is the case, business angels are ex-businessmen themselves, or women, business people, and they tend to be very knowledgeable and can be very helpful in helping you develop your business. So often, if I was offering to be a business angel to, for example, a graduate or a student, I would love to be able to mentor and help that student, but also because I have a vested interest of having, 10,000 BD invested in this person and their idea as well. Business angels, I guess, they can be supportive and helpful, and they can help you get the business off the ground, but you have to decide how much of your company you're going to give away for that investment. And it's I suppose sometimes it's better to own 60 or 80% of a £1 million company than 0% of a nothing valued company. So if you can't get your idea off the ground, then your company is valueless. Whereas if you have to give away a bit of ownership to get the company off the ground, then that's again the decision that you have to make. The number of angel investors worldwide has increased dramatically over the past decade, and it does seems to be a growth area. Particularly here in Bahrain, where we're operating this course as well. I've noticed that we run a lean startup course here as well, and a lot of our students have had a lot of interest in angel investors as well. Business angels are valuable because their willingness to make relatively small investments and are looking for companies that have potential to grow between 30 and 40% per year. Business angels were difficult, but are getting easier to find. Okay, so we've sort of said all that. So that's, what did we say, business angels and venture capitalists, and the last one we're looking at is initial public offering. And we won't spend too much time on this because this tends to be when the company is in the latter ends of growth, I guess, or maybe that's not correct actually, but well established, I guess, is what we can say. So it doesn't quite, apply to the startup company. Initial public offering is a company's first sale of stock to the public. So as we say, we've maybe given away some of our stock to a business or angel investor, to venture capitalists, and now we're going public. We're actually giving the stock away to the public through stock market trading, or stock exchanges. And we say here most entrepreneurial firms that go public trade on the Nasdaq. Well, that only tends to be because a lot of the entrepreneurial firms are tech based. So an IPO, or initial public offering, is an important milestone for a company. Typically, a company is not able to go public until it has demonstrated that it is a viable and has a bright future. So you do tend to have to be well established, and you do come under more scrutiny. In the last couple of years, companies have held back from going public too soon because it allows them to develop their technologies to a better point. Without shareholder interference in developing. So once you go public, you tend to be more heavily scrutinized by shareholders as well. Reasons that motivate firms or companies to go public: well, one, it's a great way to raise equity capital. So again, you're trading off some of the ownership of your company to fund current and future operations. So again, help you grow the company. And reason two, it raises a public profile. It makes it easier to attract high quality customers and business partners. So again, you're sort of, you're going public, you're getting the PR that surrounds that, and it does tend to create the company's brand awareness. Oh, we have some more here. I didn't even know. 3 is a liquidity event that provides a means for companies' investors to recoup their investment. Yes, so you're getting cash in, and this allows people that invested in the early stages to get some of the money back that they had invested, and obviously they invested to make a profit too. And it creates a form of currency that can be used to grow the company via acquisitions. So it just gives it a bit of weight. Sources of debt financing. Oh, I think this is the last time we just spent. Commercial banks, yes. So debt financing, yeah, as opposed to equity funding. Debt financing is mainly banks or grants, and banks, historically, commercial banks have not been viewed as practical sources of financing for startup firms. This has changed actually a little bit in recent times. Banks have got better at giving out business loans, and as regulations have loosened. This sentiment is not a knock against the banks. It's just that banks are risk averse. They're against high risk. But as I said, in recent times, they've sort of become less risk averse and sort of given more companies financing. Again, if you think about it, banks are interested in companies that have a good, strong cash flow, low leverage, audited financials. Look, it's like, a bank's only going to loan to someone that has a good reputation, no different than would you loan to someone that isn't great with money and tends to blow it all in silly things, or would you give it to someone that that is quite sensible and prudent and fiscally sensible? Yeah. Okay, excellent. Good, that is over. Okay, thank you very much, guys. As I say, today was really just an introduction to sort of introduce you to sources of funding. We looked at personal funds, equity capital, debt financing, creative sources like bootstrapping and things like that there. And again, I just wanted to introduce you to, why do we get financing and funding? How much do we need? Where do we start looking? How do we start looking? And what we'll do in our class when we're discussing that is we look at local sources of funding. So, here in Barry, and who are the people that fund new businesses and things like the EDB, Entrepreneurial Development Bank, and our Enterprise Development Bank, and there's a couple of that we looked at that help with it. So, okay, yeah, that's enough for today. Thank you. Hope that you enjoyed that, and I look forward to chatting to you all soon. Have a good day. Cheers.